allowing for its price to remain relatively unchanged after the sharp drop it is experienced from the release of the US employment report for January. We see today the release of the US CPI rates for January being critical to the direction of the precious metals price as the next big test, which is to affect the Fed's monetary policy stance. In this report, we aim to shed light on the catalyst driving the precious metals price, assess the future outlook, and conclude with a technical analysis. Later today, the market is expected to shift its attention towards the release of the latest inflation report from the US for the month of January, and precious metal traders in particular will be glued to their seats. According to forecasts, the year-on-year CPI print is expected to ease to 6.2% from the 6.5% recorded in the previous month, and should the actual rate meet the expectation, we may see the dollar ease from its one-month highs, whereas gold may shine in the eyes of investors as a result of the negative correlation between the greenback and the shiny metal. Yet forecasts are for the month-on-month break to accelerating, implying that inflationary pressures are still simmering under the surface, which may allow for the Fed's hawkishness to endure, thus softening the blow on the USD, if not provide even a bit of support for the greenback, and thus capping any gains for gold's price if not pushing it lower. At this point, we'd like to note the elevation of US yields since the beginning of the month, as it takes some of the shine from gold's price, given that investors may find bonds as more lucrative alternative to gold. Should US yields regain the upside momentum, we may see gold's price coming under pressure. Yesterday, Fed Governor Michelle Bowman underlined that the Federal Reserve will need to raise interest rates further to a sufficiently restrictive level, which will help bring inflation down towards the central bank's 2% target level. Not only that, but once the Fed is done with hiking, the most likely scenario will be to hold rates elevated for some time to restore price stability, as supply and demand dynamics could exhibit signs of divergence, the government noted. The contents of Bowman's speech mirror various policymakers' remarks over the past week, who reiterated that more needs to be done. The latest blowout employment report at the start of the month forced traders to reassess their speculative bets for a Fed pivot and renewed interest in the greenback, as the results practically leave more room for the central bank to press on with more hikes. Furthermore, the chances for a so-called soft landing scenario, where recession may be averted despite the high interest rate environment, remain prominent amongst analyst assessments, yet the results of the latest inflation report later today could reintroduce uncertainty amongst market participants' views. Not only that, but the comments from policymakers following the release could provide a clearer view into how the committee's outlook changes after an injection of fresh incoming data. Hence, we would like to highlight the scheduled speeches from Richmond for President Barkin, Dallas for President Logan, Philadelphia Fed President Harker, and New York for President Williams later today, but also other Fed policymakers that are scheduled to make statements in the coming days. Thank you for watching.